Okay, that's the word from none other than Shankar Sharma. I just want to quickly mark the new listing before we get on to our next guest, Avas Financiers, and look at the kind of market condition that this one is listing in. It's an 8.5% discount that it's listed at versus its issue price, and you can't really draw any other reason but the kind of market environment, and especially with regards to financials right now, that perhaps would lead to this kind of a sharp discount. But as Krishna Kumar, head equity at Sundaram Mutual Fund as well, is waiting by. Krishna, hi, morning. You just heard it from Shankar Sharma. Do you think there is more pain left in the system for the markets, or do you think a large part of the fall is behind us?
Hey, good morning. I think we've seen a lot of negative factors kind of coming together, both global and local, and all these have produced a concoction of uncertainties, if I may say so, in terms of the currency, the interest rates, and how the twin deficits may look like going forward. While these are the worries that we have, the markets have rightly taken note, and we are down quite sharply over the last 1 month, and particularly over the last week. I think we've lost a lot of value. So a significant part of the value destruction has already happened, and the principal sector or the NBFCs have taken it on the chin, given the spate of negative news flow that we had in the last 10 days, starting with the IL&FS issue and then the policy and the aftermath of that. I think a lot of the correction is kind of done, but there are again a host of factors, including the state elections and the results, the quarterly results that are ongoing now. These will continue to play out on the market. So I think we are headed for a bit of uncertain times, more volatility in the markets. That's the way we should look at it.
Krishna, what is it that you're making of the market mood further from here? Do you think lots will depend on what happens with crude, or like Shankar was just highlighting, that I guess what needs to be immediately dealt with, and which I guess added to the market disappointment on policy day on Friday, is the currency weakness?
I think both of them are kind of intertwined in a sense. Because rising crude again impacts the view on the deficits, and hence the currency in terms of weakness basically. So I think a lot will depend on how the Iranian sanctions play out in the next 1 month. If there is any resolution there and crude settles down to 70-75 again, then that would be a very good positive for the markets in the short run. Of course, the worries on the quarterly results, trends, and the elections in MP, Chhattisgarh, Rajasthan would be the ones to watch out for the markets. So I think macros would provide any temporary relief, but I think we still continue to look at the political climate in the country, driven by the elections that are impending. That would continue to play an important role in the next 6 months.
Krishna, just stay on with us. We have to discuss a whole lot with you regarding, your opinion in the markets and your investment philosophy, but we have to take a very short commercial break and return to that conversation. Welcome back. You're still watching the market right here on ET Now, and we're still in conversation with S. Krishna Kumar, head equity at Sundaram Mutual Fund. Krishna, let's drill it down to specifics, because we have an earnings season coming up. Do you think, with this earnings season, you would get the kind of tailwind that will support the markets? Because so far, so much has gone wrong on the macro front that I think the market is extremely nervous and sentiment is extremely brittle. Do you think earnings could be the saving grace?
I think we are going to have a earnings season where Nifty earnings should broadly match the first quarter numbers in terms of growth, and I think ex of banks you should have fairly good growth over 20%. Having said that, I think we need to watch the broader markets in terms of their performance, and our own interactions with various corporates do indicate that the companies are quite confident on their outlook in terms of growth, in terms of reasonable profit margins, and also looking forward to getting into an expansion in terms of capex mode, etc. So there is a fairly significant improvement in the business confidence when we speak to companies. So in terms of the quarter, our view is that I think the IT companies will continue to deliver well into this current season. Also, if you look at the retail banks, the NBFCs, insurance, etc., I think most of them would have a good 20% plus kind of growth in this quarter too. While on consumption, FMCG companies still report very good volume growth. There could be a little bit of easing on margins because of some cost pressures, but overall I think they should continue to have healthy growth in the second quarter too. On the discretionary side, I think the base will basically catch up too. So we do expect some moderation in numbers on the consumer discretionary side in terms of durables, or a little bit in terms of automobile companies, etc., which could or the paint companies, which could be a little bit more moderate. On the other side, if you look at the healthcare, I think hospitals, diagnostics chains, etc., should continue to report a 15-20% kind of growth based on our estimates. So also, if you look at the other spaces like logistics and other services companies, I think healthy traction in terms of growth would continue. So broadly, I think there should be little disappointments. Rather, should have a fairly inline quarter into the season.
You have a very large position in auto and auto ancillary. Now that's where the pain I think is there. Sales are slowing down. BMW has given a profit warning. The kind of sense or the sound bites which you're getting from Maruti are not indicating that 2018 or the festival demand would be like completely robust. Is it time to look at auto ancillary, rate sensitives? With consumption, there is something which is called an aspirational FMCG, and there is something called necessity FMCG, which you will continue to consume, whether it is soap, shampoo, or soap, shampoo, or toothpaste. But auto is something where interest rates will have impact, and if auto sales slow down, it will have impact on auto ancillary also.
Yeah. So you talked about a couple of things, right? On the auto side, if you do look at the numbers near term, there's been softness, and that's also because of the differential festive season as compared to the last year. So there is a reason behind the little bit of softness that we are seeing. Our channel checks with dealers, with the auto anchs, etc., does indicate that you are headed into a very strong festive season as we go ahead. So the third quarter should see a fairly good improvement in terms of sentiments and driven by volumes therein. So our belief is that our faith on the auto components would continue to help us in the medium term. We do not take short-term calls in terms of weakness on a quarter. I would rather like to play it through a longer-term view. As far as the FMCG space is concerned, there is a need to have an aspirational FMCG, but I think what's more important here is that the income levels has been pretty strong, both across urban and across the rural India. There has been a good uplift in terms of incomes, so that basically is something that's going to hold up well. while the credit basically in terms of cost of credit could be a little higher, but I think it's very important to note that on an incremental basis is what you're going to see cost of credit or cost of funding for these NBFCs going up. So on a weighted average basis, the pass through to consumers is going to be far lower and spread across a longer period of time. So I don't see any threat to the long-term story in terms of the credit cycle in the country, the retail credit and the kind of drivers for the consumption of the country. There is definitely a short-term impact driven by some of the events that we happened last month, but I think we will go through it over the next couple of months and things will normalize on the longer term. And the health of good of NBFCs which are run by good promoters, stroke managements, is quite good, and the funding costs right now for those NBFCs have normalized nearly back to the old levels before the ILFS issue happened.
Aavas Financiers listing on the bourses today, new kid on the block, 12% down. We just chose a bad time, a bad day to come to the markets. 723. This is not a time where the market would fancy anything to do with the financing space. Krishna, is it really all bets off for the financing sector for a while? I know you've touched upon it briefly, but do you be circumspect? Have you in any way reallocated your exposure to the financial sector, and if so, what are the changes?
Yeah, I think a couple of months. If you look ahead, look behind, we did have a fairly overweight positions on NBFCs. Given the kind of runaway valuations in some of the stocks, we had reduced our positions in them. So to the extent, I think now a 30-35% kind of correction, I think it would be time to revisit some of these companies. One of the good things is that our exposure has been mainly to the well-run corporate-led NBFCs that you see in the portfolio, like a Bajaj Finance or an M&M or a Cholamandalam Finance broadly. So to the extent, I think the recovery in terms of sentiment on these stocks and the performance would definitely be fairly good. So these are the guys who will be left standing even if there is a issue with the sector. So I think we are playing it more from a stock specific perspective. Even though we did like the NBFCs as a pack, I think we've been quite choosy about the stocks that we had, and we continue to back them at this point in time.
Krishna, stock specific as it may be, but would you say that the bent is largely towards large caps, or in this stock specific selective buying, you're even willing to go out and look in mid and small caps too?
Yeah, I think over the last 9 months, the small cap and mid caps have clearly underperformed the large caps, and while YTD on large caps Nifty probably are flat, small cap, mid cap indices are down more than 20-25%, and stocks probably between 30 and 50%. So to the extent, I think there's been a lot of correction in the euphoria in the small mid caps. So if you do look at some of the indices or some of our funds, valuations of mid caps are broadly in line with Nifty stocks or below the large caps, and if you look at small caps, I think they're trading at 20% discount to the Nifty. So if you look at BSE small cap index versus Nifty, you would find a good 20% discount now on a 1 year forward basis. So I think we have come back to very reasonable valuations compared to where we were earlier. And even with respect to larger companies, I think valuation comfort is emerging. So I think it would, if one has a 1 year perspective, at least, we should definitely be adding to the small cap space, and that's what we are doing.
So glad that you could take time out on a day like today when we're leaving behind us a 6% fall, and that's just on a weekly basis. Good to speak with you. By the way, that fall continues. We're sort of dwindling, struggling to stay put at that 10,300 mark on the Nifty futures. We've definitely recovered some bit of ground, but again, I would say this is just a tentative move in the first part of today's trading session. This is by no means how the market may end. The breath is tilted towards the negatives, with really metals taking it on the chin. So today is the day for Nalco, Vedanta, Hindalco. They're all down 4.5% to almost 7% now on Nalco, by the way. Motherson Sumi, after getting very hard hit all of last 10 days, today as well takes a fall of about 5.25%. Quick break, lots more lined up when we come back.